Crush your mortgage loan originator exam with Birdsy.ai. Master mortgage terms and concepts to pass your license test fast. And don't miss what's happening in the lower corner. It's your invite to try a proven new way to ace your exam. More on that in a minute. Now, let's dive in.
Let's begin with a look at loan types and products. Conventional versus government loans. What is a key difference between conventional loans and government-backed loans? Is it A, conventional loans are not insured by the government? B, government loans require higher credit scores? C, conventional loans offer lower down payment options? Or D, government loans cannot be used for primary residences? The answer is A, conventional loans are not insured by the government. Conventional loans are not insured or guaranteed by the government, unlike FHA, VA, or USDA loans. This often means stricter requirements for borrowers, but potentially lower costs for those who qualify. Which type of loan typically allows for a lower down payment? Is it A, conventional loans, B, jumbo loans, C, Federal Housing Administration, FHA loans, or D, portfolio loans? The answer is C, Federal Housing Administration, FHA loans. Government-backed loans, such as FHA loans, often allow for lower down payments, sometimes as low as 3.5%, making them accessible for first-time homebuyers or those with limited savings.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to Birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which loan type is specifically designed for veterans and active duty service members? Is it A, Federal Housing Administration, FHA loans, B, U.S. Department of Veterans Affairs, VA loans, C, U.S. Department of Agriculture, USDA loans, or D, conventional loans? The answer is B, U.S. Department of Veterans Affairs, VA loans. VA loans are government-backed loans available to veterans, active duty service members, and their families, offering benefits like no down payment and no private mortgage insurance. What is a primary benefit of USDA loans? Is it A, available only in urban areas, B, requires a high credit score, C, high down payment requirement, or D, no down payment required? The answer is D, no down payment required. USDA loans are government-backed loans that offer benefits like no down payment and low interest rates for eligible rural and suburban homebuyers, promoting homeownership in less densely populated areas. Fixed rate, adjustable rate, and hybrid loans. What is a key characteristic of a fixed rate mortgage? Is it A, the interest rate remains constant throughout the loan term? B, the interest rate can vary based on market conditions? C, the loan term is adjustable? Or D, monthly payments fluctuate with interest rate changes? The answer is A, the interest rate remains constant throughout the loan term. A fixed-rate mortgage maintains the same interest rate throughout the entire loan term, providing predictability in monthly payments, regardless of market fluctuations. Which of the following best describes an adjustable-rate mortgage? Is it A, the interest rate is fixed for the entire loan term? B, the interest rate can change periodically based on an index? C, the loan is fully amortized with equal payments? Or D, the interest rate decreases automatically each year? The answer is B, the interest rate can change periodically based on an index. An adjustable rate mortgage has an interest rate that changes periodically based on an index, which means monthly payments can increase or decrease over time. What is a hybrid ARM? Is it A, a mortgage with a fixed interest rate only, B, a mortgage with an adjustable interest rate only. C, a mortgage with a fixed rate for an initial period, then adjustable. Or D, a mortgage that combines multiple loan products. The answer is C, a mortgage with a fixed rate for an initial period, then adjustable. A hybrid ARM combines features of both fixed rate and adjustable rate mortgages, offering a fixed interest rate for an initial period before switching to an adjustable rate. Why might a borrower choose a hybrid ARM over a fixed-rate mortgage? Is it A, to secure the lowest possible interest rate for the entire loan term? B, to avoid any changes in monthly payments? C, to maintain constant monthly payments? Or D, to benefit from lower initial rates and plan a short-term stay? The answer is D, to benefit from lower initial rates and plan a short-term stay. A hybrid ARM may offer lower initial interest rates compared to fixed-rate mortgages, appealing to borrowers who plan to sell or refinance before the adjustable period begins. Balloon loans, interest-only loans, reverse mortgages. What is a key feature of a balloon loan? Is it A, fixed interest rate throughout the term? B, interest-only payments throughout the term? C, large final payment at the end of the term? Or D, no down payment required? The answer is C, large final payment at the end of the term. A balloon loan requires a large final payment at the end of the term, known as the balloon payment. This feature differentiates it from fully amortizing loans, where payments cover both principal and interest. How does an interest-only loan differ from a traditional amortizing loan? Is it A, it has a fixed interest rate throughout the term? B, payments cover only interest initially? C, it requires a balloon payment at the end? Or D, it always results in a lower overall cost? The answer is B, payments cover only interest initially. Interest-only loans require borrowers to pay only the interest for a certain period, resulting in lower initial payments. This contrasts with traditional loans, where payments cover both interest and principal from the start. What is a primary benefit of a reverse mortgage for retirees? Is it A, access to home equity without monthly payments? B, no interest accrues on the loan? C, it increases the homeowner's equity? Or D, the loan must be repaid within a fixed term? The answer is A, access to home equity without monthly payments. Reverse mortgages allow retirees to convert home equity into cash without monthly mortgage payments, providing financial flexibility. The loan is repaid when the borrower moves out, sells the home, or passes away.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Loan process terminology: Prequalification, Preapproval, and Underwriting. What is the main difference between prequalification and preapproval in the loan process? Is it A, prequalification involves a credit check, preapproval does not? B, prequalification is less formal than preapproval? C, preapproval is based solely on borrower income? Or D, prequalification requires more documentation than preapproval? The answer is B, prequalification is less formal than preapproval. Prequalification is an informal process that gives a rough estimate of the loan amount a borrower might qualify for, while preapproval is a formal process involving verification of financial documents. Which step in the loan process involves a detailed examination of a borrower's creditworthiness? Is it A, prequalification, B, preapproval, C, underwriting, or D, loan closing? The answer is C, underwriting. Underwriting is the process where the lender assesses the borrower's risk by reviewing financial documents, credit history, and other relevant factors to determine loan eligibility. Why is pre-approval considered more advantageous than pre-qualification when making an offer on a home? Is it A, it provides a conditional commitment from the lender? B, it guarantees loan approval? C, it requires less documentation than pre-qualification? Or D, it involves no credit check? The answer is A, it provides a conditional commitment from the lender. Pre-approval provides a conditional commitment from a lender, showing sellers that the buyer is serious and financially capable, often making the offer more attractive. Disclosures: loan estimate, closing disclosure. What is the primary purpose of a loan estimate in the mortgage process? Is it A, to provide a summary of loan terms and costs? B, to finalize the loan agreement? C, to record the borrower's credit score? Or D, to determine the loan's interest rate? The answer is A, to provide a summary of loan terms and costs. The loan estimate provides a clear summary of the key loan terms and estimated costs, allowing borrowers to compare offers from different lenders. It aids in informed decision-making before proceeding with a mortgage. Which disclosure is provided to borrowers 3 days before closing a mortgage loan? Is it A, loan estimate? B, closing disclosure? C, credit report? Or D, appraisal report? The answer is B, closing disclosure. The closing disclosure is given to borrowers at least 3 business days before closing, detailing the final loan terms and costs, ensuring no surprises at the closing table. In the context of a loan estimate, what does the term APR stand for? Is it A, annual payment rate? B, adjusted payment rate? C, annual percentage rate? Or D, amortized payment rate? The answer is C, annual percentage rate. APR stands for annual percentage rate, reflecting the total cost of borrowing on an annual basis, including interest and other fees, providing a comprehensive view of the loan's cost.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Loan application components. What is the primary purpose of the Uniform Residential Loan Application? Is it A, to collect comprehensive borrower information for mortgage approval? B, to assess the value of the property being mortgaged? C, to provide a legal contract between the borrower and lender? Or D, to calculate the borrower's credit score? The answer is A, to collect comprehensive borrower information for mortgage approval. The URLA, also known as the 1003 form, is the standard application used by lenders to collect financial and personal information from borrowers applying for a mortgage. It ensures consistency and completeness in the loan application process. Which section of the URLA is dedicated to the borrower's employment information? Is it A, Section 3, B, Section 4, C, Section 5, or D, Section 6? The answer is B, Section 4. Section 4 of the URLA is specifically designed to capture the borrower's employment information, including employer details, position, and income. This information is crucial for assessing the borrower's ability to repay the loan. What is the significance of the borrower's declaration section in the URLA? Is it A, it lists the borrower's assets and liabilities? B, it provides the borrower's credit history? C, it includes statements about the borrower's legal and financial status? Or D, it details the property's appraisal value? The answer is C. It includes statements about the borrower's legal and financial status. The borrower's declaration section is critical as it includes statements about the borrower's legal and financial status. This helps lenders evaluate any potential risks and verify the borrower's eligibility for a loan. financial and qualification terms, debt-to-income and loan-to-value ratios. What does a high debt-to-income ratio indicate about a borrower's financial situation? Is it A, the borrower has low monthly debt obligations? B, the borrower has high monthly debt obligations compared to their income? C, the borrower is likely to have a high credit score? Or D, the borrower has a high loan-to-value ratio? The answer is B, the borrower has high monthly debt obligations compared to their income. A high DTI ratio suggests that a borrower has a significant portion of their income committed to debt payments, which may impact their ability to secure additional loans. How is the loan-to-value ratio calculated? Is it A, loan amount divided by appraised property value? B, property value divided by loan amount? C, loan amount divided by annual income? Or D, appraised property value divided by annual income? The answer is A, loan amount divided by appraised property value. The LTV ratio is calculated by dividing the loan amount by the appraised value of the property, expressed as a percentage. It helps assess lending risk. Which scenario might result in a lender offering a higher interest rate on a mortgage? Is it A, the borrower has a low LTV ratio? B, the borrower has a low DTI ratio? C, the borrower has a high LTV ratio? Or D, the borrower has a high credit score? The answer is C, the borrower has a high LTV ratio. A high LTV ratio indicates a higher risk for lenders as the borrower has less equity in the property, potentially leading to a higher interest rate to offset risk. Front-end and back-end ratios. What is the primary purpose of calculating the front-end ratio in mortgage lending? Is it A, to evaluate total debt obligations? B, to assess housing expense affordability? C, to determine creditworthiness? Or D, to calculate loan interest rates? The answer is B, to assess housing expense affordability. The front-end ratio helps lenders assess an applicant's ability to manage monthly housing expenses. It considers only housing-related costs, ensuring they are proportionate to the borrower's income. Which of the following expenses is included in the back-end ratio calculation? Is it A, credit card payments? B, property taxes? C, homeowner's insurance? Or D, utility bills? The answer is A, credit card payments. The back-end ratio includes all monthly debt obligations, such as credit card payments, ensuring borrowers can manage overall debt in addition to housing costs. How does a high back-end ratio affect a mortgage application? Is it A, increases loan approval chances? B, indicates low financial risk? C, may lead to loan denial? Or D, has no impact on lending? The answer is C, may lead to loan denial. A high back-end ratio indicates a significant portion of income is committed to debt, which may suggest higher risk to lenders, potentially leading to loan denial or higher interest rates. Points, yield spread premium, origination fee. What is the primary purpose of a yield spread premium in mortgage financing? Is it A, to reduce the borrower's interest rate? B, to compensate brokers for higher rate loans? C, to lower the lender's risk? Or D, to increase the loan's principal amount? The answer is B, to compensate brokers for higher rate loans. A yield spread premium is a payment made by a lender to a mortgage broker for originating a loan at an interest rate higher than the lowest rate available. It compensates brokers for their services. Which of the following best describes an origination fee? Is it A, a fee for processing a new loan application? B, a penalty for early loan repayment? C, a charge for late loan payments? Or D, a fee for converting a fixed-rate loan to a variable rate? The answer is A, a fee for processing a new loan application. An origination fee is a charge by the lender for processing a new loan application. It compensates for the administrative tasks involved in setting up the loan. How do discount points affect a mortgage loan? Is it A, they increase the loan's principal? B, they extend the loan term? C, they raise the monthly payment? Or D, they lower the interest rate? The answer is D, they lower the interest rate. Discount points are fees paid up front to reduce the interest rate on a loan. Each point typically costs 1% of the loan amount and can lower the interest rate by about 0.25%.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Mortgage-related documents. Promissory note, deed of trust, mortgage. What is the primary purpose of a promissory note in a mortgage transaction? Is it A, to transfer property ownership? B, to secure the loan with collateral? C, to outline the borrower's repayment obligations? Or D, to record the property's legal description? The answer is C, to outline the borrower's repayment obligations. A promissory note serves as a borrower's written promise to repay a specified amount of money to the lender under agreed terms. It outlines the loan amount, interest rate, and repayment schedule. Which document is primarily used to transfer the legal title of a property to a trustee as security for a loan? Is it A, mortgage, B, deed of trust, C, promissory note, or D, warranty deed? The answer is B, deed of trust. A deed of trust involves three parties: the borrower, the lender, and a trustee. The borrower transfers the legal title to the trustee as security for the loan, which is released upon repayment. In a mortgage document, who retains the legal title to the property during the loan term? Is it A, borrower, B, lender, C, trustee, or D, government? The answer is A, borrower. In a mortgage, the borrower retains legal title to the property while the lender holds a lien. The borrower remains the owner, but the lender can foreclose if the borrower defaults. Escrow, impounds, and servicing. What is the primary purpose of an escrow account in a mortgage transaction? Is it A, to hold the borrower's down payment? B, to collect and pay property taxes and insurance premiums? C, to manage the borrower's monthly mortgage payments? Or D, to safeguard funds for home repairs? The answer is B, to collect and pay property taxes and insurance premiums. An escrow account is used to hold funds for property taxes and insurance premiums. This ensures that these obligations are paid on time, protecting both the lender and the borrower from potential liens or lapses in coverage. How often must a lender analyze an escrow account to ensure accuracy? Is it A, every month, B, every 6 months, C, annually, or D, every 2 years? The answer is C, annually. Lenders are required by the Real Estate Settlement Procedures Act to conduct an escrow account analysis at least once a year. This ensures that the account has enough funds to cover expenses without holding excessive amounts. What happens if there's a surplus in an escrow account at the end of the year? Is it A, the lender must refund the surplus to the borrower? B, the surplus is automatically applied to the principal balance? C, the lender retains the surplus for future expenses? Or D, the surplus is used to reduce the next year's escrow payment? The answer is A, the lender must refund the surplus to the borrower. If a surplus exceeds $50, the lender must refund the borrower within 30 days, according to RESPA. This ensures borrowers are not overcharged and have access to their funds. Regulatory and compliance terms. Truth in Lending, RESPA, the Equal Credit Opportunity Act, the Home Mortgage Disclosure Act, and the SAFE Act. Which federal act requires lenders to provide borrowers with the loan estimate within 3 business days of receiving a mortgage application? Is it A, the Real Estate Settlement Procedures Act, B, Equal Credit Opportunity Act, C, Truth in Lending Act, or D, the Home Mortgage Disclosure Act? The answer is C, Truth in Lending Act. The Truth in Lending Act requires lenders to provide a loan estimate to borrowers within 3 business days of receiving a mortgage application to ensure transparency and understanding of loan terms. Which of the following is a requirement under the Truth in Lending Act for lenders when advertising credit terms? Is it A, disclose the loan's interest rate only, B, include the annual percentage rate, C, provide a detailed breakdown of closing costs, or D, list the total amount of interest paid over the loan term? The answer is B, include the annual percentage rate. The Truth in Lending Act mandates that when a lender advertises credit terms, they must include the annual percentage rate to ensure borrowers understand the true cost of credit, promoting transparency and informed decision-making. What is the primary purpose of the Home Mortgage Disclosure Act? Is it A, to regulate interest rates on mortgages, B, to collect and disclose mortgage lending data, C, to enforce anti-money laundering regulations, or D, to provide consumer credit counseling? The answer is B, to collect and disclose mortgage lending data. HMDA's primary purpose is to provide data that helps determine whether financial institutions are serving the housing needs of their communities and to identify discriminatory lending patterns. Trigger terms, APR, Charm Booklet. What is the primary purpose of the Charm Booklet in mortgage lending? Is it A, to provide details on fixed-rate mortgages, B, to outline the application process for all mortgages, C, to inform consumers about the risks of adjustable-rate mortgages, or D, to detail the benefits of refinancing? The answer is C, to inform consumers about the risks of adjustable-rate mortgages. The Charm Booklet, or Consumer Handbook on Adjustable-Rate Mortgages, is designed to educate consumers on the risks and features of adjustable-rate mortgages, ensuring informed decision-making. Which of the following is considered a trigger term in mortgage advertising? Is it A, low monthly payment, B, competitive rates, C, easy application process, or D, flexible terms? The answer is A, low monthly payment. Trigger terms like low monthly payment require additional disclosures in ads to ensure consumers are fully informed about the loan terms. How is the annual percentage rate best defined? Is it A, the monthly interest rate, B, the interest rate excluding fees, C, the total loan amount, or D, the yearly cost of borrowing, including fees? The answer is D, the yearly cost of borrowing, including fees. The APR reflects the total cost of borrowing on an annual basis, including interest and fees, providing a comprehensive comparison tool for consumers.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Ethics and industry conduct. Redlining, steering, blockbusting. What is the primary ethical concern with the practice of redlining in the real estate industry? Is it A, it discriminates based on race or ethnicity, B, it provides equal opportunities for all communities, C, it encourages diversity in neighborhoods, or D, it is a legal requirement for mortgage lenders? The answer is A, it discriminates based on race or ethnicity. Redlining is unethical because it involves denying services to residents of certain areas based on racial or ethnic composition, leading to discrimination and economic disadvantages. How does steering negatively impact the real estate market? Is it A, it ensures buyers get the best property deals? B, it perpetuates racial segregation? C, it increases competition among realtors? Or D, it improves neighborhood diversity? The answer is B, it perpetuates racial segregation. Steering limits buyer choice by directing them towards or away from certain neighborhoods based on race or ethnicity, perpetuating segregation and reducing market fairness. Which of the following is an example of blockbusting in real estate? Is it A, providing accurate market value assessments? B, encouraging integration of different communities? C, inducing homeowners to sell by instilling fear of racial changes? Or D, offering homes at reduced prices to promote sales? The answer is C, inducing homeowners to sell by instilling fear of racial changes. Blockbusting occurs when agents induce panic selling by suggesting that racial minorities moving into a neighborhood will decrease property values, leading to unethical profit-making. Fraud for housing versus fraud for profit. Which of the following best describes fraud for housing? Is it A, a scheme to inflate property values for resale? B, a strategy to obtain multiple loans on the same property? C, misrepresenting income to qualify for a mortgage? Or D, using a straw buyer to purchase investment properties? The answer is C, misrepresenting income to qualify for a mortgage. Fraud for housing typically involves a borrower misrepresenting information to obtain a loan for a personal residence. This contrasts with fraud for profit, which involves professionals seeking financial gain. What is a key difference between fraud for housing and fraud for profit? Is it A, fraud for housing is more damaging to the economy? B, fraud for profit involves industry professionals? C, fraud for housing is legal if the home is occupied? Or D, fraud for profit always involves identity theft? The answer is B, fraud for profit involves industry professionals. Fraud for housing is usually committed by individuals seeking to acquire or maintain ownership of a home, whereas fraud for profit involves industry professionals seeking financial gain. Which scenario is most likely an example of fraud for profit? Is it A, a real estate agent and appraiser inflating property values? B, a homeowner overstating income to refinance a mortgage? C, a borrower using a fake social security number to buy a home? Or D, a family member co-signing a loan without intention to pay? The answer is A, a real estate agent and appraiser inflating property values. Fraud for profit often involves collusion among industry professionals to manipulate property values or loan approvals for financial gain. Borrower misrepresentation and predatory lending. What is a common characteristic of predatory lending practices? Is it A, offering loans to high-risk borrowers? B, charging excessive and hidden fees? C, providing clear and detailed loan terms? Or D, requiring collateral for securing loans? The answer is B, charging excessive and hidden fees. Predatory lending often includes excessive fees that are not transparent to the borrower, leading to financial strain. Such practices exploit borrowers' lack of knowledge and cause long-term financial harm. Which action by a borrower could be considered misrepresentation? Is it A, falsifying income documents? B, applying for a loan with a cosigner? C, negotiating for a lower interest rate? Or D, refinancing an existing loan? The answer is A, falsifying income documents. Borrower misrepresentation can occur when a borrower intentionally provides false information about their income to secure a loan, which can lead to financial and legal consequences. How can lenders avoid engaging in predatory lending? Is it A, offering loans with variable interest rates? B, charging high interest rates to all borrowers? C, encouraging borrowers to take larger loans? Or D, providing clear loan terms and conditions. The answer is D, providing clear loan terms and conditions. Lenders can avoid predatory practices by ensuring transparency in loan terms and fees, promoting fair lending practices, and providing borrowers with all necessary information to make informed decisions.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.